With an estimated net worth of $76 billion, that's growing steadily, Warren Buffett is unquestionably one of the most successful investors in history. Over his 52-year stint as CEO of Berkshire Hathaway, Buffett has earned nearly a 2 million % return on his investors' money. To put that into perspective, if you invested $10,000 into Berkshire Hathaway in 1965, that investment would be worth $88 million today. Most of us look at numbers of that size and assume they could come only from lottery winnings. However, Buffett took a different approach, playing the long game with the seemingly simple technique of compound interest. Has Buffett become a more skilled investor at a time when most are comfortably retired or running for president? It's possible, but that's not the reason his net worth has grown by leaps and bounds in his golden years. It's the simple investing concept of compound interest. This is when you earn interest not just on your initial investment, but also on the interest you've already earned. For an example of how compound interest works, imagine you put $1,000 in an investment that earns 10% per year. After the first year, you earn $100 in interest for a balance of $1,100. Next year, you'd earn $110 in interest for a balance of $1,210. Every year, the amount you'd earn this way would increase. Morgan Housel, the author of the popular book Psychology of Money, using an example of the ace investor, highlights how time is the most critical element when it comes to using compounding to grow one's wealth. The author points out that Warren Buffett's investment has an average 22% return on his investments annually, whereas Jim Simmons, founder of New York-based hedge fund Renaissance Technologies, has an annual return of 66%. Based on just numbers, Simmons is technically the better investor. But still, Warren Buffett's net worth is $117 billion, whereas Jim Simmons' net worth is only $25.4 billion as of 2023. How is this possible? The answer lies in the time period of investing. Warren Buffett started investing in the early 1940s, and Simmons started investing in 1988. This means that despite higher returns on investment, Simmons' wealth is no match for Buffett's wealth. Investors today are at a disadvantage to when Buffett first started out. Instant access to information and droves of quantitative processes makes it challenging to uncover hidden gems. Buffett spent decades investing during a time when there were more unknowns, there was no internet, and finding stocks that were extremely discounted relative to their book value or earnings was more common. Picking great stocks is one way to achieve outperformance, but at the end of the day, beating the market in any given year means little more than bragging rights. Rather, getting a relatively average return over time is where the real money is made. To illustrate this example, let's take three different people. One is age 25, the other is age 40, and the other is 55 years old. The 25-year-old has $0 already saved. The 40-year-old has $250,000 saved, and the 55-year-old has $1 million already set aside. All three people invest $10,000 annually in a retirement account and earn an annual return of 10% on their investment until they are 75 years old. Which investor has the most money by age 75? The answer is the 25-year-old, even though that person was broke when they started investing. Buffett's most famous quote is probably the one telling investors to be fearful when others are greedy and greedy when others are fearful. It's a timeless lesson that certainly applies to the euphoric bull market in 2021 and the sell-off we are in now. Yet it's hard to relate to someone who is one of the richest people in the world and can afford to lose tens of billions of dollars and still be fabulously wealthy. The technique combined with the 5 essential tips from Warren Buffett will be a sound investment strategy. 1. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Buffett's point sounds simple here, but it's disarmingly complex. Of course, as an investor, you're trying to profit in the market. But one of the best ways to do that is by avoiding loss. When you eliminate decisions that expose your portfolio to loss, what's left is more likely to be a gain. When you have more money in your portfolio, you can compound your gains even faster. This approach has implications for how you invest. Buffett's quote suggests that instead of looking for the highest upside, you should be looking to avoid loss first and only then look at gains. That's a different mindset from investors who view the stock market as a slot machine. 2. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Here, Buffett suggests that when you see an opportunity, you need to act quickly and decisively. When the odds are stacked in your favor, such as when stock prices are down significantly, you need to invest heavily, because good prices might not come along again soon. Buffett often takes this approach when markets are down significantly. He amasses a ton of cash during the good times, and then invests aggressively when stocks plunge. Having a lot of safe cash on hand allows him to use this strategy. 3. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. While some investors think investing is a lot about the numbers, Buffett suggests that investing has much to do with the behavior of investors themselves. When investors are greedy and push the prices of stocks to the sky, Buffett becomes fearful, because a market plunge may soon follow. In contrast, when investors run away from the market or a specific stock, Buffett becomes more interested because prices are cheaper. When stocks are cheaper, they don't have the same risk as when they're expensive. And this is how Buffett thinks about avoiding losses. 4. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. While some value investors focus on buying only the cheapest companies, Buffett suggests a better course of action is to buy wonderful companies, those with better economics and competitive positions. Part of the difficulty here is that whereas fair companies may go on sale relatively frequently, the great companies rarely look cheap. But a company with a good competitive advantage will likely continue to make money over time, and it can bail you out if you purchase at a too high price. That may not be the case for a fair company, which may falter and never return to your purchase price or beyond it. 5. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Here again, Buffett touches on the value of temperament for a successful investor rather than intelligence. Rather than trying to go with or against the crowd, investors should analyze what's going on in the market, regardless of who likes what stock. By focusing on the objective facts, investors can make decisions that are relatively free of emotion and make better choices. That was all from us today, folks. For more similar content, make sure to subscribe to the channel. See you in the next one.